Hey everyone, PJ Patterson here for the weekly update. Week ending 25th of October. As you all know, I am here in Phoenix, Arizona, visiting my mom and going to be starting in a baseball tournament in a couple of days. So, having a good time, looking forward to it, but still working and still keeping an eye, one eye anyway, at least, and in most cases, two eyes on the markets. Today's update is going to cover three things, or top three things today are going to be the continued global deceleration. Specifically, I'm going to highlight and talk about Asia and look at some of the US numbers as well. Secondly, I'm going to talk about the US Fed, QE, and the upcoming interest rate decision, which will be coming up on, I think, Wednesday of next week. We've got a Fed meeting here in the US. And then finally, I'm going to touch on China and delve in a little bit more deeply into some things that I've only really just had made present to me about China and their behavior, and probably will help put into context what's really going on with the trade war and some of these issues that we're seeing played out at a very high level in the media. So I'm going to delve a little bit more deeply into that. So first and foremost, let's talk about global deceleration. I'm just going to grab some data here. First of all, the U.S. continues to decelerate. And this is part of the global deceleration. But just focus here on this ABC. We had durable goods orders slowed to minus 5.4% over year. Durable goods is a very big measure of the U.S. economy. If U.S. durable goods are in decline, that's very bad, a very bad sign for economic activity and for the economy at large. CapEx in the U.S. has slowed, and GDP growth has slowed in the U.S. Now, to put that into perspective globally, just flipping over to another global data dump, as you know, I often show these tables during our updates, and I get these every single day and look at them. But the key thing to highlight whenever you see these is a lot of red is bad, and green is good or okay, or good, I suppose, and yellow is kind of, it's not good or bad, it's sort of neutral. And of course, depending upon what the metric is, a red number could be very, very bad. So if you just look at Australia there, you see that our PMI numbers, and this supports the global growth slowdown that I've been talking about now for the better part of at least the last 4 or 5 updates, probably longer. But we're clearly seeing, not just in Australia, but worldwide, the PMI numbers falling. Now, there's no other, well, Germany's got a little bit of a PMI a bump here in their composite, but only a smidge. It's not a great deal. But the Eurozone, Germany, France, South Korea, Japan, Australia, the US, Hong Kong, you name it, China, I think I said China already, we're all slowing. There continues to be slowdown. And this is a point that you cannot overlook because the stock market seems to be, the U.S. stock market anyway, and to a lesser degree, the Australian stock market continues to sort of trade at a slightly elevated level. Now, I think that's going to change this month. We'll see. I don't know. And I'm going to talk about how it could change in just a moment. Let's see. Yes, but one other thing I wanted to highlight here as well on some charts, and I'll talk about this in a moment around the U.S. Fed, but the CRB index seems to have turned and is potentially heading up. Now, what this is all about is inflation. So we may be seeing early signs of an acceleration of inflation. Now, that's a very interesting dynamic to be in where you have some inflation and you have declining growth. That's called stagflation, and that's a really, really bad. You've probably heard that. For anyone listening to this who's got a bit of gray hair on their head, you've probably heard that term before, and it's not a good place to be. We do not want to be in a stagflationary environment. In any case, just going back to the global growth theme, this is the Hong Kong stock index chart, continuing to show that it is rolling over. It is not these little peaks and bounces that we're getting. We're getting lower highs, we're getting lower lows, and all this talk about a trade deal, which I'll touch on in a second, just gets these little spikes and then they roll over. So again, we're not really seeing anything to get too excited about on these charts of stock markets like Hong Kong, Shanghai, etc. They continue to be in a downward bearish trend. Here, there's durable goods charts going negative there. Again, negative U.S. durable goods ex aircraft and defense, capital goods orders going negative. Just not good, just not good at all. Now, just to quickly touch on one final thing here before I move on to the U.S. Fed, we've had about, I guess it's almost a little bit under half of the S&P has reported earnings to date. So 191 companies out of 500 have reported earnings. And as you can see, earnings growth isn't looking so good. I've been talking about earnings growth now for a little while. Earnings growth in specific sectors as well is quite bad. Information technology is not good. Last night we had Amazon post a negative number, or they missed, I believe, revenue estimates, and the stock got clobbered. There's been other examples of that as well. On the flip side, we had Intel, which is the maker of microchips. They reported, I think, slightly better than expected earnings growth or revenue, one of the two, and the stock went up. But it wasn't, a monumental sort of, we've beat the number by a huge wide margin. So what we're generally seeing at the moment in earnings reporting is companies are reporting, if they're reporting a little bit of growth, that's fine, but it's not anything to set the world on fire. And they seem to also be indicating and warning about future growth. So the stock market, again, is not really discounting this. It is not yet pricing this in. And the reason for that, which I think is a great segue into this, the reason for that is the U.S. Fed. Now, the U.S. Federal Reserve has instituted another round of QE. I talked about this, I think, last week or the week before last, where the U.S. Fed has, because of liquidity concerns in the market, and I'll touch on that one in a second, but because of liquidity issues in the U.S. market, which of course greases the wheels for the global economy, the U.S. Fed set up a repo facility. Now, what a repo facility basically is if I'm a bank, let's say I'm a bank, and I've lent out a lot of my capital, I've leveraged that, and I got a bunch of mortgages. And for whatever reason, I can't meet capital requirements, or there's something that's happened internally. I've had to do something where I don't have enough capital on my balance sheet to that's liquid to meet the requirements set by any number of government institutions, but basically the U.S. Treasury. So what I do is I loan some of my mortgages to the Fed. It's called a repo or repurchase facility. And what the Fed does is it advances me liquidity. It effectively buys those assets, gives me liquidity. Then at some point in the future, I buy those back and I pay a small fee to do that to the U.S. Fed. That's basically what a repo facility is. And so the Fed has set up a repo facility that's going to provide something in the order of 35 to $100 billion a month of additional liquidity. Now that, ladies and gentlemen, is quantitative easing. They are buying assets and they are monetizing those assets. That's a very simplified view of it, but that is exactly what they're doing. And so one of the things that the stock market in the U.S. and globally, for that matter, likes is when the Fed does QE. It's like a sugar rush. When the Fed does QE, markets typically go up. So I think the market continues to levitate on the Fed and the fact that they are doing and have reinstituted quantitative easing. Now, just to pivot slightly to the upcoming interest rate, Fed interest rate decision next week. The Fed is in a very difficult position. A lot of the Fed members, the voting members of the Fed, believe that they don't have, and shouldn't need to at this point cut interest rates very deeply. So maybe we'll see a 25 basis point cut. And furthermore, they don't necessarily think that they need to continue cutting them, because the U.S. economy isn't in crisis mode. It's not doing great, but it's not doing terrible either. On one side, they have Donald Trump, who is constantly harassing them through Twitter and the media, calling them, dereliction of duty and calling them all sorts of names and stuff, saying they need to keep cutting interest rates. Now, of course, Donald Trump's going to say that. He's a president who's facing re-election and needs a strong economy. So, of course, he's going to be badgering the Fed to cut interest rates. Now, the Fed, on the flip side, has got to maintain, first of all, they need to maintain some cushion, because if we really do get a big, GFC style crisis, they do not have a lot of room to cut interest rates before they get to zero. Now, they can go into negative territory. We've never seen that before in the United States, and whether we see it in the next 12 to 24 months, who knows? But the main issue is the Fed doesn't really have the cover from the economy, the economic data in the U.S., and the earnings in the stock market to really cut rates deeply. Now, some of the durable goods orders and things that might give them enough cover. They might talk about that in their report. Who knows for sure? But what's going to be interesting with the Fed is the language they use around future cuts. So the market's pretty much pricing in a 25 basis point cut from the U.S. Fed. What will be interesting to see, though, is if their language, and everyone always hinges on every word of this Fed statement, whether they say anything about continued cuts or additional cuts or being data dependent or any of this funny language that might spook the market. And I can tell you, ladies and gentlemen, if the Fed does not seem to be ready to provide further accommodation, that could very well be the catalyst for a repricing of the stock market. Now, who knows? I do not know what's going to happen. I do not know what the Fed's going to say. Even a 25 basis point cut isn't baked in the cake. They could come with 50. If they come with 50, the market's going to rocket up in the short term. If they only do 25, well, and then they say we're kind of done for a little while, the market might initially pop, and then it's going to probably roll over. Who knows, right? We just play the hand that we're dealt when we get there. So any discussion I give you about what could happen is all I'm guessing at this point in time. But what I'm not guessing about is the data. The data isn't lying, and the data continues to suggest extreme caution in this environment. Now, I'm going to pivot to China because there's a lot of stuff that's going on in the media right now around these trade talks. Now, would you believe that these trade talks have been going on for well over a year? And we've had the ups and downs around, yes, we have a trade deal, no, we don't. Yes, we have a trade deal, no, we don't. We're 90% of the way there, blah, 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 all this stuff. And I've been watching some very interesting interviews about China, and I've got to admit that other than knowing where China is and that they're a huge part of the global economy and all this other stuff, I didn't know a lot else about the Communist Party in China. I didn't know much else about their human rights track record, and I didn't know a lot about their banking system and how over-levered their banking system is. So I'm going to touch on a couple of things with China because this is fascinating. I've got a really cool book on the way as well. I'm hoping to read it while I'm here in the States from a retired brigadier general named, I believe, Jeff Spalding, who spent a lot of time in China but has ended up being an expert on China for the U.S. military, and then now an advisor to some think tanks and some other high-level bureaucratic positions that he's had in the U.S. government. And the story that I'm hearing from him and another gentleman, a very, very well-known investor named Kyle Bass, who runs a firm out of Texas called Heyman Capital, who is a huge China bear and is just ringing the bell that there's problems in China. I've watched some really fascinating interviews about the seriousness of this China issue. Now, I'm going to try to articulate a couple things to you because I think that my understanding of China has changed dramatically in the last sort of week after watching these interviews and then basically watching these interviews and then looking up some stories. So I want to first of all touch on an article that just has come out today where one of Trump's advisors, this is Navarro, Peter Navarro, who is one of the president's trade advisors. Here's the crux of this trade issue with China. China steals technology from the U.S. and from other countries in the world. Full stop. Everyone knows this. They are not held to account on that score. A lot of this tariff stuff has to do with the fact that China is not playing fairly on the global trade field. Now, just bear with this for a moment. We all know that China's economy is reasonably developed, but it isn't fully developed. And the cost of labor there is really still quite cheap compared to other parts of the world, particularly the United States. This is why the manufacturing sector has moved a lot of their manufacturing over to China. Now, what that does immediately is it hollows out an industry or a sector of an economy, i.e. the U.S. manufacturing, and it ships it overseas. Now, that's great for the U.S. consumer because they can buy cheaper stuff, but it's horrible for the U.S. consumer because they've just lost a shitload of jobs. This is the same thing that's happened with Mexico, where jobs went there, and other parts of the world, Vietnam, probably Thailand, Cambodia, and places like this. So one of the equalizing mechanisms that a country will use to offset that loss is to tariff those items that are coming back into the country. And the reason you stick a tariff on there is, I guess to equalize the loss of the manufacturing. So probably because the government has to support more people, whatever, they need more money to do that. So they tariff the good. And I suppose it's also an incentive for the business to consider not relocating their facility over to another country and actually keeping it, in this case, in the United States. But there are other concerns about China, which have to do with the fact that a lot of their theft of technology and they do a lot of espionage, really, you could call it that, around technology and stealing from U.S. firms. And furthermore, one of the other issues that the U.S. has with China has to also do with their human rights and some of the issues around human rights with China. And I'm just going to drop a couple articles here. I mean, you can look this stuff up yourself on Google. You don't have to believe me on these things. But I didn't know this. But one of the things that goes on in China is the harvesting of human organs. And I was stunned when I read this. I did not actually know this. And it's very unsavory. I'm not going to go into great detail here, but you can look this up on your own. But apparently, this is fairly widely known, and it's horrendous. It is absolutely horrendous. First of all, China is one of the world's worst human rights violators when it comes to persecuting people within their country. And Falun Gong, you've probably heard of, they're sort of a religious group in China, but they also persecute Muslims there, and probably dissenters too. I mean, the Chinese Communist Party is a prolific persecutor of anyone that is viewed as a dissident. And this is what's playing out in Hong Kong. And this is why Hong Kong is so important. Because the people in Hong Kong is a capitalist country, full stop. They are absolutely capitalist. They have a lot of Americans, a lot of Brits there, a lot of wealthy Chinese there. And it is absolutely a democratically run country. And China's trying to step in there. And this whole protest movement that's going on in Hong Kong is about the fact that there was legislation that had been tabled to effectively allow for the extradition of Hong Kong citizens or residents, I guess, to China, to the mainland China, to be prosecuted. Now, China does not have a rule of law like we have a rule of law in the US and in Australia. We're pretty lucky in that way. China doesn't have that. And so the people in Hong Kong are like, screw that. Like, that is not happening. And that's why the people are so pissed off. And that's what is going on there. And this is exposing some very serious issues in the way China deals with things like dissenters. So there's this whole undercurrent of stuff going on between Hong Kong, China, and the US. And that's why this trade deal probably keeps stalling, because behind the scenes, the US, and here's another interesting article, the US Secretary of State has been very vocal. Now, the president, not so much, because he obviously has other people that'll do this for him. But the Secretary of State, Mike Pompeo, has been really sticking it to the Chinese around their human rights issues. And that's his job to do that. But look, to wrap this up with China, it is to say that, yes, China has added a tremendous amount to the world in terms of being able to produce cheap goods and all of this sort of thing. But they are still a communist country. They still are totalitarian. They still do not provide their citizens with universal suffrage that you and I are accustomed to in countries like the US and Australia. And they are playing the game very well in terms of lulling everyone into a false sense of security, making and throwing money around and making connections with various political entities, etc. This is why, if you think back to all the articles we've seen in the Australian press recently around these Chinese figures who are getting pinged for political contributions and for trying to buy Australian companies. I mean, let me sum it up this way. I am now present to, and I'm really looking forward to reading this book from General Spaulding. And I'm going to, once I read it, I'm going to give you guys a review on it. But I'm fascinated to read it because I actually think that we have to be very, very careful now about how we relate to China and what we allow them to do or infiltrate or set up in, particularly in Australia, because that's where I live. One of the issues I've highlighted in the past is food security. So I am absolutely supportive of our government not allowing Chinese interests to purchase Australian farmland, Australian dairy assets, any Australian asset. It should be Australian owned and Australian controlled. Full stop, the end of story. It should never fall into foreign ownership at all. And this is something that you need to be aware of because it could impact all of us in our lifetimes. Um, the final thing I'll just mention about China, and this is a very interesting situation that has unfolded, is China needs US dollars. Now, I'm still trying to get my head around all of this, but basically, China built up a huge reserve of US dollars during the last, let's say, 30 years of trade with the US because they were constantly selling goods to the US. They built up this huge foreign reserve. But now they're trying to maintain a peg of their currency. And there's some other issues around this as well. But they're trying to maintain a peg of their currency, and um, they've had to use their U.S. dollar foreign reserve currency reserves to do that. And there's a problem brewing with China not having enough U.S. dollar reserves to call upon to manage their currency peg and do a few other things. And this is something that potentially could explode in China's face. And it is a bargaining chip. It's not a very hugely talked about one, but it's a bargaining chip that I'm sure the U.S. or a leverage chip that the U.S. is no doubt using against China. And it's also, I dare say, why China has been setting up an alternative currency system or global trade settlement system to the US dollar. And I think they're desperate to do that because then if they're able to do that, they will have less reliance on the US dollar. It makes total sense now when you understand that they have a US dollar liquidity problem. So I think that's all I'm going. I've gone on for a very long time on this interview, but there's some really of this interview of this update. There's some really fascinating things going on in the world. I think to sum it up, I'll just say this: we are still at risk. It is October, and we still have a week left in October. We could still get a major stock market event this month, but it could still unfold in any time in the next month or two. So I'm definitely keeping an eye on that. We have the Fed meeting coming up, which is going to be interesting and could be the catalyst for a reset in valuations or in the stock markets. And finally, we have this trade deal and China floating in the background. And I want to make sure that you understand the argument and the reasons why this is so critically important for us as Australians, but also for our U.S. cousins, of course, of which I am one, because it's a larger issue and it's much more complicated than just putting a trade deal together. So with that, I will sign off and say have a fantastic weekend. And I will give you another update most likely next week, although I will be playing baseball, so I'll hopefully be able to squeeze it in between games. But please do have a fantastic weekend and a fantastic week, and I look forward to seeing you when I get back.